So just looking at the broad markets then and the strength of the gains we're seeing this morning, put that in some kind of context for us, could you? What do you think is behind optimism? Is this a increasing role of retail investors here, seeing good opportunities to buy still, or what do you think is happening?
Yeah, I think from a positioning perspective, as you point out, the retail investors have been given quite large stimulus through this period in both Europe, Asia and America, particularly in America. And they've really been participating in the rally. But what's quite critical to note is as well that actually the kind of cash levels at the normal, mutual fund long only sort of market, according to Bank of America, are still at levels not seen since 2009. And that's the same for sort of hedge fund positioning and CTA positionings within hedge funds. A lot of people aren't long this market, which you were saying earlier. And there's a huge amount of pessimism in the stock market, which is one of the sort of reasons why I believe it can keep rising. And I think we're in this trade-off between knowing that the rest of this year is going to be very difficult, knowing that next year is probably going to be very difficult, and most people aren't expecting 21 levels of earnings to get back to even 2019, and yet markets can rally through that. And the underlying theory behind that is that where else are you going to put your money? Isn't the best single investment, high quality businesses on a global basis? And I think that is still very much true. Bonds yield zero. Sorry, Matt.
Well, at the same time, we have had an incredible rally, Freddie, from the bottom in March, and we have valuations, certainly in U.S. stocks, at historical highs, basically, around the highest levels you typically see valuations. So stocks are expensive. And for some reason, Americans, to a large part, refuse to wear masks, almost on political grounds, which is helping to spread the coronavirus even faster than pretty much any other country on the planet. Aren't those three things enough to concern you when it comes to U.S. stock markets?
So the latter is the most concerning, the fact that the US really, quite remarkably, has not got the virus under control. And that just has been one of our theories all the way through, that it would keep ravaging state to state and actually be very, very hard to put out, more like a whack-a-mole problem, whereas individual countries, even in Europe, they are individually managed and they have been much better at containing the virus. I think on the valuation point, it's very critical to note that a huge portion of that valuation excess versus history, or the reason why the markets are expensive, is because the tech and the growth stuff is very expensive. So growth stocks are trading at their 100th percentile expensive compared to the value end of the market, if you want to classify it like that. If you look at US banks, they're trading incredibly cheap compared to history. Energy stocks, certain other stocks, retail stocks, we still believe are very cheap in America, and certain other, nearly all cyclical stocks, even the highest quality ones. So, Texas Instruments is a stock we bought in March, which is a high quality cyclical business. Air Liquide in Europe, and Linda would be an American equivalent. These are high quality businesses that are trading at massive discounts. It's only the defensive growth that's trading at the extraordinary valuation premium. And because it's done so well for a decade, it now makes up such a large portion of the market that it skews the averages.